Let's talk about the top story this morning. U.S. economic growth accelerated more than forecast in the second quarter, illustrating demand is holding up under the weight of higher borrowing costs. Gross domestic product increased at an annualized 2.8% rate in the April to June period after rising 1.4% in the previous quarter. That's according to the government's initial estimate. The economy's main growth engine, which was personal spending, advanced 2.3%, and that was also more than anticipated. Now, even though the pace of growth picked up in the first quarter, the figures still represent a moderation compared with last year's numbers. In fact, consumer spending and broader economic activity have both cooled under the weight of higher interest rates, which is also helping to tame inflation gradually. Now, bets of aggressive rate cuts by the Fed had been rising in recent days, and that's amid the debate over whether the central bank should act when it meets next week. But with the latest proof of a resilient economy, relatively resilient economy, you should say, some of those expectations will be tempered. Now, to talk about the implications of this latest print, I'm joined this morning by Peter McGuire, who's the Chief Executive Officer of XM Australia. Peter, thanks so much as always for taking the time. Bit of a surprise, this GDP number. Of course, when you look at the numbers versus the last quarter, looks good. But versus last year, there seems to be a bit of a moderation. What does that mean for monetary policy?
Well, good morning, Alex. Greetings from Sydney. Probably a hotter print than what we expected. But when you're thinking about it and you're looking at a forecast of 2%, we came in at 2.8. So in some ways, it was very, very strongly, I suppose, the growth over that last quarter. And when you're thinking of where we are as far as Fed rate policy and how they're going to interpret that data, we're also conscious as far as the PCE and whether we've got to be at 2% before Fed Chair Powell says, yes, you're going to have a cut. So there's many moving parts to this. And I think it's going to be, again, a very interesting week ahead.
So what does this mean for risk assets and the way that they've been moving? Of course, Treasury yields spiked a little bit after yesterday's print. They've broadly been heading lower in anticipation of the move lower by the Federal Reserve. What is your own estimation of how risk assets will move and how the Fed will move? Will it cut in September or will it push it further down the line?
Well, a couple of things. First off, it's going to be, if you put your mind back to the last six elections since 2000, there's a very big chance, I think, that they won't do anything because from a political interference. But then there's the other side, of course. Are you going to see, I think, expectation from the market? And the market has very much baked this in. So I feel as though that, yes, you'll see a rate cut and it'll probably be 25 basis points. It'll probably be in September. Now, as far as equity markets are concerned, you've seen a bit of a pullback as far as NASDAQ and certainly the S&P over the last week. Will that continue downdraft? I feel as though it's probably consolidate a little bit once we get through the end of this week. And then we've got to work ourselves closer to that election, which typically the last 2 months coming into an election period, you do see a sell-off as far as equities.
So from that perspective, when you're looking at the emerging markets as well, and you watch India very closely as well, I know that for a fact, Peter. Do you wait and watch? Is that the approach that you take?
I think you've got to hedge. I think that's the first part. If a trader's not hedging, he's got to be very conscious, or she's got to be conscious as far as any possible downdraft and take advantage of that. So you're hedging your position, or at least, cutting it square. The other side of it is, what other asset classes do you put money into treasuries, or do you just sit on the sideline and appreciate what you've experienced over the last 20 or so months? And it's a time of consolidation. So many traders have a differing viewpoint. And I feel as though you've got to, fortune favours the brave, but you've also got to have your head screwed on as far as opportunity. And there's some time to sit on the sidelines. That doesn't hurt you.
Yeah, thanks so much, Peter, for taking that time and speaking to us this morning.